Look at the markets overall, and they are down. We're going to bring in Joe Duran of United Capital. He's the CEO, and you've got billions in assets too, Joe. Tell me right now what you're doing. Are you buying on a day like this where we have turmoil over Greece and, of course, over a failed trade deal?
We don't really look at any given day and buy or sell. We're really looking after people's entire net worth and looking out years. I will say we're not selling. And if anyone's coming in today, then they're being invested into the market. So what we've been preparing clients for is a much higher volatility environment. And candidly, I feel very good that we aren't down for the year, really. When you look at all of the headwind we've had, a really weak first quarter, the Fed very clearly articulating they're going to be raising rates and removing the punch bowl. I'm surprised how little volatility we've had. We've been 900 days without a decline of 15% or more. That's unheard of. It's double the average. So I'm surprised we haven't had more of a decline, to tell you the truth. But again, I don't think you're going to see in the next decade a decline like we've experienced in 2000 or in 2007. So I think you're going to see regular market volatility come back in, and certainly more than we've had in the last few years.
Well, as we put up a couple of your picks, I guess I would then ask you, is this that we're not going to see this gigantic correction that you just mentioned, is that because the Fed is still propping up these markets with a nice soft pillow?
Well, what the Fed has basically said is we're not going to remove the nice soft pillow until the economy is very steadily on its feet. And that might not happen at all at the speed that we think. So they will maybe, I think you can be pretty sure there'll be a very small and modest increase this year, but they're not going to do anything else until there's a real need. And what I think you'll see is the whole world has oversupplied money to the system, which has reduced volatility, and they're not going to remove it until the economy is growing, which will mean that earnings are growing. Well, and so what I think you'll see is a normal level of declining.
And then we've got the Greek situation. Going into the weekend, it doesn't appear that anybody really wants to be long stocks at the moment. I guess the fear of contagion, if we do see a Grexit or Greece exiting the Eurozone, you worried about that and how it might affect the markets?
Of course, we should all worry about it. The reality is everything's interlinked in this global world. What you want to do in this environment is own larger cap stocks that are protected from the kind of volatility you'll see in smaller companies. You should also invest in things that are going to do well in a rising interest rate environment. Again, you're better off with larger companies than smaller companies. You want to avoid long-term maturity debt because I think you have a lot more risk there than you're being paid for. And you want to make sure, again, if we're in higher volatility times, that you're allocated the way you intended, because what's happened with market doing quite well is that people are now overweighted to stocks and have maybe more risk in their portfolio than they currently understand. So batten down the hatches just in case.
We shall, and thanks for the good advice. In fact, we're going to put this interview up on LizClaman.com so everybody can hear that you just gave them a roadmap on how to invest in a very murky time. Joe, it's good to see you. Thank you. Joe Duran.